Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at PI, or Impinj Inc. PI is a manufacturer of radio frequency identification devices and software. Here's the bar chart technical opinion rating for PI. The bar chart rating is a 100% buy with the strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that PI is well above the moving average line, so the monthly trend in PI is up. Now we're going to look at the daily chart. The stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. Right now, the blue line is above the green line, so the daily trend in PI is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. PI is below the upper Keltner channel line, so PI is inside the buy zone. Since the trend is up, we want to buy a call. PI has 6 option chains to choose from. We're going to use the April 19 option chain. Right now, the April 19 options have 48 days to expiration. Here's most of the PI option chain for April 19. PI closed at 112.65 on Friday. That means any calls on the list from 40 to 110 are in the money. Let's take a look at the profit potential for purchasing the PI 115 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 115 call is 740 to 860. We try to enter at the midpoint, so we'll use 8 even as the buy price. Our call option calculator shows the profit potential for this call based on PI price changes at option expiration from flat to a 12.5% increase in price. We can see that if the PI stock price is flat at 112.65 at option expiration, the 115 call will lose 100% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out a trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 100 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 100 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the PI stock price is up 1%, the 100 call will lose 16.3% of its value. We want that to be break even or better, so the 100 call does not meet our requirements. Let's see if the 85 call will work. The bid-ask spread for the 85 call is 26.50 to 30.50. We try to enter at the midpoint, so we'll use 28.50 as the buy price. The 85 call works. If the PI stock price is up 1%, the 85 call will make a 1% or $28 profit. That's better than break even, so the 85 call is the one we'll buy. The call option purchase calculator also shows that if the PI stock price increases by 2.5%, the 85 call will make a 6.9% or $197 profit. If the PI stock price increases by 5%, the 85 call will make a 16.8% or $478 profit. If the PI stock price increases by 7.5%, the 85 call would make a 26.7 or $760 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the PI stock price does not make the expected move up and remains flat at expiration, the 85 call would only lose 3% or $85 compared to the 100% or $800 loss for the 115 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the PI April 19 expiration 95 strike call and sell to open the PI April 19 expiration 105 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 95 call for $19.95 and sell the 105 call for $13.40. $19.95 minus $13.40 equals $6.55. So the entry price or debit cost for the spread is $655. The call option spread analysis calculator picture shows that the spread will make a 52.7% or $345 profit if the PI stock price declines by 5%, remains flat, or increases in price when the options expire. If PI is down 7.5% at expiration, the trade will make a 40.5% or $265 profit. Creating the debit spread will allow us to collect a $1,340 cash credit to our brokerage account for the sale of the 105 call. As we said on the previous slide, this reduces the cost of entering the spread to $655. Here's a note regarding earnings reports. The next PI earnings report is scheduled for May 9. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the PI April 19 expiration 85 strike call for $28.50. We also reviewed the spread. The spread said to buy to open the PI April 19 expiration 95 strike call and sell to open the PI April 19 expiration 105 strike call at a debit of $655 or $655. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.